This training is being put on by the Office of the State Auditor's Pension Division. My name is Rose Hennessy Allen, and I'm the Director of our Pension Division, and I'm joined by our wonderful pension analysts, Mike Johnson, Molly Resch, and Maya Dabney Miller. So our session today will be divided into 3 sections covering Relief Association legislative changes enacted during the last 3 years. Okay, in section 1, we'll cover law changes passed during the 2019 legislative session. The Department of Revenue worked for several years on legislation that recodified the fire state aid and the police state aid provisions, which means that these provisions were rearranged in statute. The fire state aid and police state aid provisions had been combined in one chapter in statute, which also contained other provisions that were unrelated to either of these aid programs. Now, the fire state aid provisions have been moved to the newly created Chapter 477B, and the police state aid provisions have been moved to the newly created Chapter 477C. And there were only technical updates that were made as part of the recodification. Another change has to do with vesting requirements. This 2019 law change was made for the defined benefit plans to make the vesting options for these plans parallel to those for the defined contribution plans. The defined contribution plans had been allowed since 2004 to offer full vesting or 100% vesting to members who completed at least 10 years of active service. Now, defined benefit plans have this ability too. So previously, members of the defined benefit plans were required to complete at least 20 years of active service for full vesting. Now, full vesting can be offered after 10 years of active service. And members of both the DB and the DC plans still must have at least 5 years of service for partial or reduced vesting. Permitting a shorter vesting requirement was seen by some as a way to help fire departments that are facing challenges in the recruitment and retention of firefighters. This law is permissive rather than mandatory, and it provides relief associations with flexibility to address the needs of their community. Relief associations that want to change their vesting requirements must do so by amending their bylaws. And our bylaw guides up on the website include sample language that you can use if you'd like to make changes to the vesting in your bylaws. Some examples that we've seen relief associations implement include providing partial or reduced vesting after 5 years of service, and then setting the full vesting at 15 years of service. So reducing it from the 20 years that was previously required, but not going all the way down to the 10. To kind of try it out for a few years and see the effect on retention before deciding on whether to go to the 10-year. Some other relief associations have chosen to only offer fully vested service pensions and to offer them to members with 10 years of service. So this would be cliff vesting, where people either get all or nothing. So a member who serves for 10 years would be fully vested, but someone who left prior to that wouldn't get anything. And relief associations can choose to make no change and continue operating and requiring the 20 years of service for full vesting. A final note on this topic is that both the defined benefit and defined contribution vesting provisions were rewritten to make them more clear and to prohibit a relief association from requiring more than 20 years of service for full vesting.
All right, thank you, Rose. Let's go into our first poll on this topic. All right, in the answer to the poll of which plan types can offer full vesting after 10 years of service, if specified in the bylaws, is all plan types. And again, just to reiterate, the 10-year full vesting provision is optional if the relief association wants to put in their bylaws. If they do not want 10-year vesting, they do not have to amend their bylaws to offer it.
Thank you, Molly. The next change we'll talk about is benefit levels for firefighters with a break in service. And this change was made to address a concern that was raised by relief associations that members who are on a break in service or a leave of absence when they end their firefighting career should be paid a service pension using the benefit level when they last were active, rather than the level that was in effect at the time of their separation. Generally, service pensions and benefits must be calculated using the benefit level in effect on the date that a member separates from active fire department service and membership in the Relief Association. And separating from service means permanently ceasing to perform firefighting duties with the department. So sometimes a member has a break or a leave at the end of their firefighting career and then resigns or is terminated without coming back to active service. So prior to this law change, the benefit level used to calculate the service pension for these members was the benefit level when the member resigned or was terminated, which may have been higher than the benefit level in effect when the member was last active. So to avoid situations where firefighters share in benefit increases when they no longer are actively serving, this change was made so that if a member has a break or leave at the end of their career, the benefit level in effect when the break or the leave started is the level used to calculate the benefit. In addition, a definition of break in service was added to the statute as this phrase hadn't been previously defined. Okay, return to service. So this 2019 change also pertains to members who have a break in service or a leave of absence. Members who return to active service after a leave or a break are usually referred to as return to service members. And there are provisions in law that define how their benefits are calculated after they return. This change allows relief associations, if they want to set a different vesting requirement for members who return after being paid a service pension or a disability benefit. And allowing relief associations to define shorter vesting requirements for these members who come back after being paid out is a way to help keep firefighters in the fire service. So if a relief association wants to amend its bylaws to define a shorter vesting requirement, the firefighter has to wait at least 60 days after being paid out before they can resume active service with the fire department. In addition, the shorter vesting requirement only applies to firefighters who come back to the same fire department after being paid out. And upon the resumption of service and membership, the firefighter then starts over for pension purposes, so they would start over as a new member. Relief associations electing to define shorter vesting requirements for these return to service members have the authority to define the minimum service requirements as they want to in the bylaws. So an example could be that vesting could be set at 3 years for firefighters who come back after being paid out. And then a firefighter who returns for 3 years would be fully vested and would qualify for a second service pension. That would be based on the 3 years of new service. Another option would be to set a graduated vesting schedule for these return to service members. And so that graduated vesting schedule would be similar to how vesting would work for other members, but with the vesting starting earlier. So the bylaw guides that I mentioned up on our website also include samples that you can review if you'd like to implement this change. And we'd also be happy to discuss any specific questions that you might have.
Next, we'll take a look at some audit requirement changes that took effect in 2019. In 2019, Minnesota Statute 69.051 Subdivision 1 was clarified to make clear that audits for relief associations must now include a legal compliance audit using the OSA's Legal Compliance Audit Guide. The audits for relief associations must follow the minimum audit procedures prescribed by the OSA. This revision to the statute will affect relief associations with assets or liabilities of at least $500,000 or assets or liabilities that have exceeded this threshold in a prior year. Once a relief association surpasses this threshold requiring an audit, even if a relief association then drops below the $500,000 in assets and liabilities, an audit will still be required on an annual basis. These relief associations will require an annual audit and must comply with the new legislation requiring that these audits include a legal compliance audit following the OSA's Legal Compliance Audit Guide. We have many resources available on our website to ensure compliance with this new requirement, including our legal compliance audit guide. And the effective date of this new statutory requirement was May 31st of 2019. Next, we'll be taking a look at some changes in supplemental benefits. Also in 2019, Minnesota Statute 424A 0.10 subdivision 1 was revised to expand eligibility for supplemental survivor benefits, and this change was to now include designated beneficiaries and estates. The intent of the supplemental benefit is to help offset state income taxes that must be paid on a pension benefit distribution. Designated beneficiaries and individuals who receive distributions through an estate generally have the same tax concerns or obligations as other recipients of service pensions or survivor benefits. Therefore, the legislature took this into account and a change was made to expand eligibility for supplemental survivor benefits to now include designated beneficiaries and estates. Prior to that, it was surviving spouse, surviving child or children, and now the designated beneficiary and estates have been added. The recipients of a lump sum service pension or disability benefit receive a supplemental benefit, and that's going to be equal to 10% of the base service pension amount, or with a maximum up to $1,000. And the recipients of a lump sum survivor benefit receive supplemental benefits equal to 20% of the base pension amount up to a maximum of $2,000. Relief associations can apply for reimbursement from the state of Minnesota for supplemental survivor benefits and supplemental benefits paid to qualified recipients. And these disbursement or reimbursement forms can be located on the Department of Revenue website, and they can be submitted from mid-November through February 15th of the following year. And so anybody that has paid out supplemental reimbursements can go on the Department of Revenue website starting in mid-November and fill out the form, and they will be reimbursed for these supplemental benefits. And the effective date of this statute change is January 1st of 2020, and it applies to supplemental benefits paid by a relief association in 2019, and thereafter for the death of an active or deferred volunteer firefighter, which occurred on or after January 1st of 2019.
All right, thank you, Mike. Let's launch our next poll on the eligibility for supplemental benefit reimbursements. All right, in the answer to the poll of which benefit type payments are eligible for supplemental benefits are partially vested service pensions, long-term disability benefits, survivor benefits, and deferred service pensions. So basically, if you are paying a lump sum service pension, disability benefit, or survivor benefit, that payment is eligible to have a supplemental benefit.
Next, we'll take a brief look at legislation that was passed regarding investment reporting thresholds. And the threshold at which additional investment reporting is required to the OSA was changed from $25 million to $50 million. So prior to this law change, relief associations with investments totaling more than $25 million had additional investment reporting requirements to our office, and this would occur on an annual basis. This legislation has changed this threshold from $25 million to now $50 million. And since the passage of this legislation, the threshold for relief associations to have to submit additional investment reporting to our office will now be the new $50 million threshold. There were some changes to the benefit levels for deferred members, ancillary benefits. In 2019, Minnesota Statute 424A.02 subdivision 9 changed the law so that the ancillary benefit provision for relief associations with a defined benefit plan has been updated to provide clarity for deferred members receiving ancillary benefits. And so ancillary benefits are disability and survivor benefits. Relief associations can choose whether or not to offer disability and survivor benefits. And if a relief association does offer disability and or survivor benefits, they must be offered in the bylaws of the particular relief association. The benefit level used to calculate deferred member disability and survivor benefits must be the benefit level specified in the bylaws of a relief association. So we encourage all relief associations that are looking to either add disability and survivor benefits or currently have them to review them and make sure that the benefit levels are specified in the bylaws of your particular relief association. If a relief association's bylaws don't specify a benefit level for deferred member ancillary benefits, the disability benefit or survivor benefit must be calculated using the benefit level in effect on the date of the member's separation from active service and membership, or the benefit level in effect when the member last was active if there was a break in service or a leave of absence at the end of the individual's firefighting career. And this new legislation took effect January 1st of 2020. Next, we'll be looking at changes in statute for the 2020 legislative session. And so these will be changes that affect fire relief associations in the 2020 session, and we'll go through some of them and give a summary of how they apply to individual fire relief associations. The first topic we'll be taking a look at is the fire chief certification of service credit amounts. So the fire chief must certify service credit amounts on an annual basis. And this has been reduced, so the length of time of certification to the Relief Association and municipality was the primary reason for the law change. And now the fire chief must notify each firefighter of his or her previous years of active service credit. And this notification must be provided to the individual firefighters 21 days before certification. And the reason that this is occurring is so individual firefighters can review their active service credit. And if they see any discrepancies or they want to talk about their service credit that's being credited with the fire chief, this will give them time to do so. And so once the fire chief has notified individual firefighters of their service credit for the prior year, they are then certifying the credit amounts to the Relief Association and the municipality by March 31st. So on an annual basis, the fire chief will be certifying credit. They'll notify individual firefighters 21 days before the certification date, and then these new certifications will be due to the city and the relief associations by March 31st. The certification must be expressed as the number of completed months of the previous year for each firefighter, but these amounts cannot exceed 1 calendar year.
All right, thank you, Mike. Let's launch our next poll on this fire chief certification. All right, and the answer to the question of is there a specific form or format that must be used to make the certification is no. The fire chief has the ability to make a form or format that works best for your relief association, as long as the roster and how many months of service credit each member has for the year, then the rest is up to the fire chief.
So we previously touched on the audit requirement changes in legislation in 2019. And this audit requirement clarification states that it must be conducted in compliance with generally accepted auditing standards and not required to be a yellow book audit. So the change corrects the 2019 audit legislation which had mistakenly required compliance with generally accepted governmental accounting or auditing standards. And so the 2020 law change corrected this mistake and made sure that Relief Association audit requirements remain as intended and at the same threshold as that for cities. This change made clear that a Yellow Book audit and generally accepted governmental auditing standards would be replaced with the required compliance with generally accepted auditing standards. So the term governmental was removed from the statute to refer now to generally accepted auditing standards must be followed. Quite a large change in 2020 refers to the defined contribution investment allocation provisions, and all deferred members now must receive investment allocations on or after January 1st of this year, 2021. And this is specified for defined contribution plans. And this will apply to members who are currently deferred and to any future deferred members. All members that would be considered inactive members must receive investment allocations in the same manner as active members do. So the bylaws for defined contribution plans must be amended, and the changes must be approved on or before December 31st of this year, 2021. And the investment allocations can be paid in one of the following ways. So there are three options that are available to defined contribution plans now on how to allocate investment income. And this would be a separate account where deferred members are pooled together, and their investments would be, the portion of their investments would be invested separately from the active and inactive members. And once a member would seek to receive a benefit, their portion of that account would then be drawn from and the member would be paid. The second option is the separate vehicle option. And what this option allows for is the Board of Trustees to set up a separate investment vehicle for each deferred member. So each deferred member would have their own investment, which the Board of Trustees would oversee. And when the member then seeks to have a benefit payment made to him or her when they're eligible, the investment vehicle would then be transferred to the member, either in a payment or in a transfer to a IRA account. The other option are full gains or losses, and members that would defer under this option would receive, like it says, full gains or investment losses, whatever a particular year provided for as far as markets go. So some years deferred members might see large gains. They also might see losses in some instances. So these are three separate ways that defined contribution plans can invest or can provide for investment allocations. And it's really up to each individual relief association to determine which system would work best for them. Now, if a relief association that's a defined contribution plan does not specify in the bylaws what investment allocation method that they're going to use, there is a default option in statute that calls for the use of full gains or losses. So it's really important for defined contribution plans to review their bylaws to determine if they're actually providing for a specific investment allocation type. And if they are not, they can either use the default method, which is full gains or losses, or if another option would be preferred, then the bylaws of the Relief Association should be updated to comply with statute.
All right, thank you, Mike. We know this topic's a little bit more complicated, so let's launch our next poll to review the information. All right, and the answer to the poll of who must receive investment allocations beginning on the 2021 DC table is active members, inactive members, and deferred members. And I do want to reiterate, if you have questions on this topic here, please contact our office and we will be able to explain it a little bit more detail for you.
Thanks, Molly. Earlier, we discussed the 2019 change that now allows all relief associations to offer full vesting after at least 10 years of service. So during 2020, the accrued liability calculation for the defined benefit plan active members was changed to take into consideration the lower vesting requirements. If a relief association offers full vesting at 10 years of service, it means that higher benefit amounts can be paid out after a shorter length of time. And these higher liabilities were not being taken into consideration on the schedule form, which could have resulted in unfunded liabilities for the relief. So the actuarial firm for the Legislative Pension Commission reviewed the liability calculation that was set in law and made some suggestions to make sure that lower vesting would be factored into the calculation. Now, starting with the 2021 schedule form, the liability calculation is based on a relief association specific requirement for full vesting and retirement, and each individual member's age and length of service. The new calculation determines the present value of future benefits that will be payable and reduces those future liabilities by a 3% investment return assumption for each year until the member reaches the minimum retirement age. So relief associations will notice that accrued liability amounts now will be different. So for example, if you have two members with the same length of service, but they have different ages, the liability for the member who's younger will be less because the relief association will be able to fund more of that future benefit with investment earnings. When a relief association becomes deferred, the member's estimated benefit amount is calculated, and that calculation is different than the accrued liability calculation for active members. So for deferred members, the estimated benefit amount is entered on the deferred tab of the form, and depending on the benefit level, the member's age, and the member's length of service, the active and deferred amounts may differ, and sometimes by quite a bit if the benefit level is relatively high. Fire state aid allocation. So this was a big change. This change was the result of a fire state aid work group that met for several years. Generally, if there is a relief association in existence, all fire state aid and all supplemental state aid are required to be transferred by the city or town to the relief within 30 days. And this law, the 2020 law change, provides an exception to that requirement for combination fire departments, where both the city and the relief association agree on an aid allocation agreement. Combination fire department is a department that has both full-time or career firefighters and volunteer or paid on-call firefighters. And there are about 80 combination departments in Minnesota right now. All of the fire departments are city departments except for 2 or 3 that are operated by independent nonprofit firefighting corporations. So if the relief association and the city both agree to an aid allocation agreement, then the fire state aid can be split between the city and the relief association based on that allocation method that's defined in the agreement. The city uses the portion of fire state aid that it would retain to pay employer contributions to PARA, or the Public Employees Retirement Association, on behalf of the full-time firefighters. And then the city would transfer the relief association's portion of the aid to the relief within 30 days. If there is an aid allocation agreement in place, it only applies to fire state aid, or that 2% portion. Supplemental state aid all still has to be transferred to the relief within 30 days. Supplemental state aid is payable under the Police and Fire Supplemental State Aid Program, which was the new aid program established in 2013. Supplemental state aid is paid out at the same time as the regular fire state aid portion, and it shows up as 2 separate line items on the transfer from the state to the municipality. The new law includes specific things that have to be defined in the agreement, and the agreement has to be submitted to our office by March 1st each year in order for it to be effective for splitting aid that year. So if this is something your community wants to do, please submit the agreement to us before March 1st so we have time to review it and let you know if there are any issues that need to be resolved before it could be effective. Also, if the fire state aid for a community changes by more than 50% during a year, either the city or the relief could choose to terminate the agreement and then renegotiate it based on the updated aid amount.
All right, thank you, Rose. Let's launch our next poll on state aid. All right, and the answer to the poll of a relief association could split supplemental state aid is no. Only the fire state aid portion, or that 2% money portion, can be split between the municipality and the relief association.
Thanks, Molly. Now we'll talk about dissolutions. So the dissolution changes are the result of a work group that was convened by the Legislative Commission on Pensions and Retirement. And the work group reviewed the process for relief association dissolutions and plan conversions. The dissolution changes define how the relief association's organization is dissolved and also how the retirement plan is terminated. The changes were made to comply with federal IRS requirements and to address concerns that firefighters had with the old process. So prior to this law change, if a relief association dissolved, any special fund money not paid out as benefits was required to go to the municipality. And the old law only allowed regular vesting, and so only the vested amounts could be paid out. So there was the potential for large surplus amounts to go to the city or to the town instead of to the firefighters. The dissolution under the new process is usually initiated by a relief association's board of trustees. The new law does include a provision, though, for what's called an involuntary dissolution, which would occur if the fire department that the relief is affiliated with is dissolved, or if the fire department has terminated all of the firefighters who are covered by the relief. So if a fire department is converting to an all-career department, an involuntary dissolution of the relief could be triggered if the paid on-call firefighters are terminated and the board of the relief doesn't act. We encourage the Relief Association's Board of Trustees to initiate the dissolution if possible, because the board has more options and more flexibility if it initiates the dissolution. So for defined benefit plans that have a surplus, and if they are dissolving, the Relief Association is allowed now to increase its benefit level to help reduce the surplus amount. The benefit increase can be made without the consent of the municipality or the independent nonprofit firefighting corporation. So the Relief Association can increase its benefit level up to 125% of the maximum. So let's say the relief's maximum allowable benefit level for the year is $9,000. The Relief Association could increase its benefit level up to $11,250, and no city ratification or approval would be required for the increase. So increasing the benefit level and then also fully vesting all members, which is required now with the dissolution process, should eat up most of the surplus if the relief has one. If there is still a surplus remaining after the benefit level has been increased and after everybody has been fully vested, there's a process that defines how the remainder will be divided up. And so the first step in the process is that if the municipality paid any required contributions to the relief during the last 10 years, the amount of those required contributions would be repaid to the city or to the town. If there weren't any contributions that were required, or if there's still a surplus after paying back the required contributions, then any remaining surplus amount is split between the municipality and the relief. The relief and the municipality have to mutually agree on how to split up the assets. And any of the surplus funds that are retained by the relief are allocated out to the members. And there are a few options on how those allocations could be made. So the new dissolution provisions can be found in section 424B.22, and relief associations should work with an attorney and with their auditor during the dissolution process. The process includes notification requirements and really is something that the relief association will need an attorney to help with. because in addition to the requirements in that section 424B, relief associations also have requirements as a nonprofit corporation. And so during a dissolution, those requirements could include things like notices and filings with the Secretary of State's office, the Attorney General's office, and the IRS. The conversion provisions are also the result of that work group that met on conversions and dissolutions. Currently, the statute only defines how a relief would convert from a defined benefit plan to a defined contribution plan. It's our understanding that legislation will be done at some point to authorize a process to go the other way too, but that hasn't been drafted up yet. And this initial legislation was done as a way for relief associations with a defined benefit plan that has a large surplus to allow them to convert to a defined contribution plan and then allocate out that surplus to the members. The conversion process is initiated by the Relief Association's Board of Trustees. Consent of the municipality is only required if the relief has a deficit at the end of the fiscal year before the conversion effective date. With the conversions, we again recommend that relief associations work with an attorney and their auditor during the process. The conversion process requires bylaw changes, notices to members, and valuations of the benefit amounts. So the conversion process is similar as that for a dissolution because the conversion really is a termination of the defined benefit plan and then the creation of a defined contribution plan on the same date. Termination of the defined benefit plan in the plan conversion requires full vesting of all members, similar to the dissolution provision, and also permits a benefit increase if the relief has a surplus.
So there has been a change in the statutes regarding defined benefit plans and how maximum lump sum benefit levels can be paid as far as the amounts. And so in this legislation, the lump sum benefit plans are able to increase their lump sum benefit levels from $10,000 to $15,000. And so this legislation in effect affects any plan that offers a defined benefit component to their pension plan. And these plans would include defined benefit plans, or what's commonly known as lump sum plans, and also monthly lump sum combination plans. Previously, the maximum benefit per year of service that these plans could offer was $10,000, and this would be dependent on if they were adequately funded or not. And this has since changed to now allow defined benefit plans the ability to offer up to $15,000 per year of service if they in fact have adequate funding. The defined benefit plans and monthly lump sum combination plans must submit a maximum benefit worksheet to our office, and that's going to be submitted to our office on an annual basis, and this will allow relief associations to determine the maximum allowable amount that they can go up to as far as a benefit level is concerned. And so the maximum benefit worksheet, again, will offer a guidance on what adequate funding the Relief Association has and the maximum allowable amount. And this will be based on whether or not the Relief Association has the required funding to go to that level. So on an annual basis, Relief Association should be looking at the maximum benefit worksheet closely to see what their average financing is, and also to see if their benefit level is in line with what the maximum allowable amount is. And they should always take into account, when deciding whether or not to raise their benefit level, the impact that it will have on the finances of the Relief Association, and also if it'll impact the city in ways such as having required contributions.
All right, thank you, Mike. Let's launch our next poll on maximum benefit levels. All right, and the answer to the poll of if a relief association can increase its maximum its benefit level of 15 grand, if its maximum benefit worksheet states 12,000, and the answer is no, a relief association can't increase its maximum or its benefit level over the maximum calculated on your maximum benefit worksheet.
Okay, let's move on to section 3.
So in our final section, we're going to be reviewing the legislative changes that took place in 2021, and we'll go through the various changes and their impacts on relief associations going forward. So the first change was to separated non-vested member forfeiture provisions. And so this allows relief associations with a defined benefit plan to forfeit service credit if a non-vested member is absent from firefighting service for at least 5 years. And a relief association can now amend the bylaws of their relief association to allow for the forfeiture of non-vested service credit after at least a 5-year waiting period. If a member returns to service within the 5-year waiting period, the member retains the original years of service and accrues additional service going forward. So if a member returns to service after the waiting period, the member will start over as a new member and will lose their original years of service. This legislation is permissive, and relief associations wanting to forfeit service credit of non-vested members would need to do so by amending their bylaws. And this change in the statute for defined benefit plans is consistent with how non-vested member accounts are handled in the defined contribution plans.
All right, thank you, Mike. Let's launch our next poll on this topic. All right, and then answer the poll is if it is required for a lump sum plan to forfeit non-vested service credit after a 5-year waiting period is no, it is not required. Relief associations that would like to do so would need to add a provision to their bylaws specifying when non-vested service credit would be forfeited.
So also in 2021, there were additional audit requirement changes to statute. And so the audit threshold requirement is based solely on the amount of the special fund assets and liabilities for a relief association. So relief associations over $500,000 in assets and liabilities are required to have an annual audit completed. And relief associations under the $500,000 threshold are required at a minimum to have an agreed upon procedures report submitted to our office, or an AUP as they're known. And this needs to be done annually. And the CPA conducting the agreed upon procedures report would need to sign the financial reporting form, also known as the FIRE form, that are submitted to our office on an annual basis as well. Previously, relief associations' annual financial reporting form is certified by a CPA in accordance with the agreed upon procedures if the relief association does have assets and liabilities that are both less than the $500,000 threshold. So some relief associations that are below this threshold do choose to have an audit prepared instead of an agreed upon procedures report, even though a full audit isn't required in statute. So this legislation is meant to make clear that relief associations below the $500,000 threshold may choose to have an audit prepared on an annual basis. And if a relief association does submit an audit, the CPA is not required to sign the FIRE form. This new legislation exempts relief associations that choose to have an audit prepared from the form certification requirement.
Thanks, Mike. Okay, combined service pensions. Relief associations have had authority for a long time to pay what are known as combined service pensions to members with active service in more than one relief association. A combined service pension means that years of service among multiple relief associations are combined for purposes of vesting. To pay a combined service pension, the bylaws of each participating relief have to be amended to allow for those combined pension payments. And assets are not transferred between or among relief associations when a combined service pension is payable. Instead, when a member who's eligible for combined service pension retires, the member is paid a pension from each participating relief in which they've accrued at least 1 year of active service credit. Each pension is based on the benefit level in effect for that specific relief, or for defined contribution plans, it would be based on that member's individual account balance. The law change that was enacted this year was done to make the Relief Association combined service pension provision closer to how portability works for volunteer firefighters in the PARA statewide plan. And under the new law, a firefighter must be vested in the first relief association to receive a pension from that relief. Vesting then accumulates if the firefighter joins a subsequent relief association, and the firefighter must join the subsequent relief within 2 years. And then the firefighter or the subsequent relief can request a written notice from the prior relief association to confirm the active service credit. And if that's requested, it must be provided by the relief secretary.
So going back to the defined contribution plans and their deferred interest options, the legislation in 2021 provides a window of time to amend the bylaws of the Relief Association retroactively to change investment allocation methods for currently deferred members of the Relief Association. And this is solely for defined contribution plans. And this is a pretty rare instance when the Relief Association can retroactively make changes to the plan. And these bylaw revisions must be completed by January 1st of 2022. In the 2020 pension and retirement bill, the law was changed on how investment returns are allocated to members in a relief association that is a defined contribution plan. So beginning January 1st of this year, 2021, deferred members of the defined contribution plans must be credited with investment returns. And this new requirement applies to members who are currently deferred and to any future deferred members going forward. So again, there are the 3 options for crediting investment returns to deferred members. As we went over them before, they are the separate account, separate vehicle, and the full gains or options or losses options. And if a relief association's bylaws do not define this method for crediting investment returns to their deferred members, the deferred members will be credited with their proportional share of the full gains and losses of the relief association's investments. And so members who are currently deferred and separated from active service when a relief association's bylaws provided for an allocation method that isn't any longer authorized in state statute, they must start receiving investment return allocations under one of the 3 currently authorized allocation methods going forward. And so relief associations that need to update their bylaws to comply with this new statutory change can also find sample bylaw language on our website that can help them craft the language that they need for their specific needs in the bylaws of their relief association.
All right, thank you, Mike. Let's launch our last poll on this topic. All right, and the answer to the poll of can DC plans retroactively change their investment allocation method for current deferred members is yes, it must be before January 1st, 2022. And I would like to reiterate that this is a very rare occurrence that a relief association can retroactively change its bylaws.
Next, we'll be taking a look at the definition of a municipal clerk. And so in 2021, the legislation adds a definition of municipal clerk in the Relief Association statutes. Previously, the term municipal clerk was not defined in state statute. And so a definition has been put into state statute, and including this definition into state statute allows some flexibility for municipalities when signing relief association forms and who is allowed to sign these relief association forms. So the new definition of municipal clerk in statute now reads, means the person elected or appointed to the position of municipal clerk, or if the governing body of the governmental entity designates the position to perform the function, the financial chief officer of the governmental entity or the chief administrative official of the governmental entity. So by having a current definition of what the municipal clerk is and who potentially could be considered to act as the municipal clerk when signing relief association forms does give the municipalities flexibility to determine who they want reviewing the forms and then also signing the relief association forms that are due to our office on an annual basis.
Okay, well, thank you all so much for taking time to attend our session today. If you do have any questions that we didn't cover today, we would love to hear from you. So please email us or give us a call. Thank you so much. Bye.